Hello, everyone, and welcome to my YouTube channel. Today, I have a very special guest, good friend, and one of the most interesting and brightest minds in the financial world, Keith McCullough. He's the CEO of Hedgeye and author of this book, Diary of a Hedge Fund Manager, a book that all of you must purchase and read. How are you, Keith?
I'm very good. Thanks for welcoming me to your YouTube channel. This is really cool.
It's a great pleasure. And one of the things that our friends and our audience, who are mostly small investors, people that follow the finance world, they tend to look at the world today and the way to invest very much from the perspective of investment banks and from the perspective of the news that they receive, which basically are talking about just following central banks and following trends. And what you and I know is beta chasing. I would like if you could summarize the importance of investment process and what is in particular your investment process when navigating such a complicated environment as the one that we're in today.
Yeah, and I think beta chasing is a great way to say it. It's a more polite way of saying macro tourism. I think you and I both agree. If you want to be a macro tourist, you just jump from headline to headline and you use, as I affectionately call, old Wall Street research, which basically uses linear models and a lot of I guess assumptions that start with things that are also linear, whereas what we do is instead of jumping from headline to headline where you're constantly reacting, what you're trying to do is proactively predict what they are going to be reacting to by jumping from data point to data point on a time series. So all I do to really boil it down is I use rate of change, or I believe in gravity. I don't believe that the earth is the center of the universe, like valuation, like some people think, that's what makes markets go up and down, because it doesn't. What makes things go up and down are the rates of change of both growth, GDP growth, and inflation, accelerating or decelerating. And we can get into it, but I have a 4-quadrant model, or what we call the quads, where we have 4 different economic environments that we're basically trying to front run before the crowd gets there and they're reacting and reading the news every day.
Mm-hmm. And in terms of following those data points and the rates of change, which I think is a very important factor. Many people see, well, it's still in expansion. Data is showing strong levels of growth, but it's the rate of change and the marginal level of improvement or worsening data that actually makes the big difference. And one of the things that almost every investor right now is confused with is this idea that, well, maybe those things that Keith and Daniel are talking about are right, but central banks are going to solve it all. And therefore, the only thing that I need to do is just close my eyes and ride the wave, catch a wave, and you'll feel on top of the world, like the Beach Boys.
Yeah, well, that's not the way to do this. It's not our first rodeo. I think one of the many things you and I have in common, which include looking at the world from a calculus perspective, which, as Steven Strogatz, who wrote the book Infinite Powers, cleanly states, calculus is the secret to the universe, Daniel. So it really is. I mean, when you start to measure and map economies, and what you find is by backtesting it, as opposed to theorizing on what markets should, could, or would be under any central market planning event, to your point, is that they cleanly follow the rates of change of growth and inflation. So one really good example is if you get the long-term and trending rate of change of inflation rate, you get the long end of the bond market or the 10-year yield rate. Mm-hmm. So when you're in what we call quad 2, when you have both growth and inflation accelerating at the same time, in rate of change terms on a year-over-year basis, that's the only quadrant. There's only one quadrant where bond yields go up. There's only, they're in the U.S. it's the best quadrant where bond yields go up. So instead of sitting there, with your thumb in your nose or in your ears or something, in June of last year, you could have known that inflation was going to accelerate and that bond yields were going to bottom and take off. And here we are almost a year later, and everybody I think were surprised by inflation accelerating last week, which is to me a little crazy. But we don't want to be crazy. We want to be, again, front running the proactively predictable actions and emotions of crowds. And finally, on that central banking point, you can front run them too. Yeah. When inflation starts to get towards the top end of the cycle, as you know, the Federal Reserve has a very good track record of doing precisely the wrong thing at the wrong time in the cycle.
Mm-hmm. And I guess that I know that one of the good things about being focused on the process and data driven is that you can get the timing a little bit wrong. You can see that the rate of the pace of change is different, but at least it allows you to react on hard data instead of expectations. Yes. or this loose concept of sentiment, which I find fascinating to say the least. Is when they say, no, the bull to bear ratio is still saying buy. What does that mean? No?
Oh man, if you give me a ratio, I'm giving you are linear right back at you, and I might call you something else on Twitter. I just don't, I don't get it, because the back tests don't. Like, why would you use something like a simple moving average?
Yeah.
It's, again, a simple moving average, a 50-day moving monkey, as I'll call it. It's a one-factor model. It doesn't include any volatility adjusting, and what really makes markets change are the volatility of the market. And we can get into that, because it's not just understanding that it's the rates of change of the cycle on growth and inflation that matter, but it's the market signals that are front running that. So I put those two things, the signal and what we call the quads, together, the signal being more important as it front runs the quads. And all that poppycock, all that talk about ratios and multiples and this and that, it might sell a newsletter, but it's not going to generate alpha.
Yeah. One thing that we get quite a few times comments from the audience is, okay, well, what you say makes sense. However, if what you say makes sense and it's not something that is hidden or a secret, you're talking about it constantly in public, why are investment banks and the mainstream economists not doing the same? And I always say the same thing. And you come from the hedge fund world, as I do. We come from the portfolio management side, and we know that the sell side, investment banks, mainstream economists, the academia, etc., have a professional incentive to consistently provide information that aims at buying or thinking that everything is going to go up. So it's not just that it's that what you're saying is something that is widespread and well known. Is that the reason why it's not more implemented is because it's not the business of investment banks, and it's not the business of mainstream economists to look at those elements, because they are not there. We are not there to sell products. And economists are not there to sell bonds or equities. They're there to talk about policy. But you and we're looking at P&L. No, do you agree with that?
100%. I mean, there's nothing more motivating on Wall Street than your P&L.
Yeah.
And whether or not you're generating alpha or not. Hence why you called them beta chasers. Mm-hmm. If you want to be beta, there's a very low fee that you could pay or paid, really not pay with no commissions now if you live in the US to just own SPYs. I mean, you can, there is zero edge in that. That's why I do think that the fear-mongering community of newsletter writers has resorted to just one-way fear. Gold bugs go one way, which is only up. Bitcoin maxis, it's all evangelists, right? Because the only way you can make a buck because you can't generate alpha is to either do those types of things, or to your main point, which I think is the most important one, which is really the foundations of why I started Hedgeye, is research. Unlike buy-side research or research that's generated to generate P&L and alpha, it's the old walls research or the sell-side research is conflicted, it's compromised, it's constrained in all of its regards because of all the conflicts of interest associated with their banking relationships, their broker-dealering, et cetera, et cetera. When all your ratings are buy, or 90% of them, I think most people in this day and age with an internet connection can understand that. So I think that that's been easily parked over here. What's been interesting is that over there, where, hybrid economists, I'll call myself at best, and you who actually, are more formally one, because all I have is my BA in economics from Yale. Like, I'm an undergrad. I'm a neophyte, but I have a major in market timing. I have a major in combining, the principles of my own economic models. And what you find is, just like you did when you were at Citadel, or I did when I was at Dawson and then at Magnetar, is that I basically built my own model. And I think that unless you build your own models, you don't know how they break. You don't know how they work. You don't know how they're working for a lucky reason. You don't know when they're not working for unlucky reasons. There's so many different ways. And I think that that's another thing that you and I have in common. We've been doing this, like I've been doing this for 22 years. I mean, you do need a lot of reps to build those models, and you got to make a lot of mistakes too.
Absolutely, absolutely. One of the things that very few people understand when you speak with investors, retail investors in particular, is the factors that move a stock. No, I have people in the audience, very good friends that have written with very detailed research about the so-called fundamentals of a company, that fail to understand that in most cases, what you're buying is 80–90% terminal value and more exposure to external risk factors than to the margins and so division. No, how do you think that in a world in which assets are becoming more correlated than ever, bonds, equities, because of monetary policy, etc., do you see that those risk factors affecting external risk factors affecting a particular stock or a particular group of stocks have become even more important than in our hedge fund time? Or do you think that we're starting to see a different angle there?
No, I think we are in a particular time, particularly in the hedge fund space. It's hedge funds against the machine that they created, so to speak. Yeah. If we just, this is a very interesting topic where maybe we'll learn something as we go back and forth on it, because it's still something that's dynamic. It's changing. It's nonlinear. It's just like everything should be or is in your life, right? So markets aren't very different. But when you take factor exposures, for example, and you use my framework, so I have 4 quadrants. I have 2 factors. It's a 2x2 model, growth and inflation. So again, quad 1, 2, 3, and 4. In each of those 4 quadrants, certain factors go up and certain factors go down. What makes those factors go up and down? Not captain of the universe at some hedge fund who has a valuation opinion on a company. Absolutely not. It is the prevailing conditions of growth and inflation. So what I'm observing this year is literally by the month, and it can be, I'm generalizing here, 1, 2, 3, 4, 5 days in a month, where a factor exposure quite literally implodes the hedge fund business, because they're all on the wrong side of the wrong factor, number one, and number two, telling their investors that they are neutral to that factor. So the most obvious example we can go through, they happen every month. So I got five factors. Today's factor is the crypto factor. But the month of January is a very good example of that, where in quad 2, where we're currently economically, where both growth and inflation are accelerating. One of the best things you can be long from a factor exposure perspective in U.S. equities is high short interest stocks. Right? So high short interest stocks, you have all these super smart hedge funds that are smarter than I'll ever be, but guess what? They're who I used to be. You and I have had to numb ourselves down, because what we used to do in this business is not the game that we're in now. You have to literally have changed and dynamically evolved what you do to accept that you have no idea when the factors flip. So why not front run those factors? So again, people were shorting stocks at 3 to 5 times earnings with 30, 40, 100% short interest. And then lo and behold, it blows up the whole hedge fund business for a week of trading. And then the cycle starts. Well, the cycle never went away economically, to be clear. It was a factor exposure that blew people up. And you can go to rate sensitivity in the month of February. You can go to small cap as a factor exposure in April. Every month, it's one thing or two things, or the constellation of things. More importantly, that work from a factoring perspective in each quad. So I think that the manifestation of running neutral with leverage creates a liquidity problem for those who are levered to those factors at the particularly wrong time in cycle time.
That's very interesting, because Since the financial crisis, we have seen a trend. I don't know if you agree with me on this, in which hedge funds have gone from being market neutral, beta neutral, factor neutral, to very long to try to adjust to the cycles that they were not getting either correctly, or to try to capture some of the market correlation that was being increased throughout the large the large stimulus packages. No, so in essence, what we have seen is that obviously being market neutral does not reduce risk, it reduces volatility. But by aiming to capture some performance by increasing length, what you end up doing is both increasing volatility and risk. Would you agree with
Yes.
that? Yeah.
100%. I mean, that's what creates, I mean, and I was generalizing when I'm saying, like, as you know, whether it was where you worked or where I worked, running neutral is in principle orientation how they believe the money should be run. Tiger Cubs don't think of it that way. They should run with gross and net long leverage that that is materially different. So what I think is happening is that you put more, and if you go back actually to January and February of this year, January in particular, what you found was a lot of the major hedge funds that are running neutral were running with too much gross. In other words, they're running neutral, but the gross leverage to neutral was intolerable. And that's what really, I think this ties back to, and I'm curious as to what you think. Obviously, you're the author of this, and I pay attention largely to what you say, and not so many others, is where's the Fed's role in this? Because the Fed is incentivizing people and the country and other countries to run with more and more and more and more leverage. Yeah. You can do more with less capital and more leverage. So I do think that the Fed is largely, causal in terms of setting, people on these railway tracks. But I don't think that they're railway tracks that you can get off. I mean, if you even look at the implosion of the Asian hedge fund, it's a former Tiger Cub in Chinese stocks. I mean, if you're looking at my nowcast, I have China in quad 3. It's the only quad where you should not be long China consumer stocks. And here this guy is like running levered long China consumer stocks, and all the investment banks are letting them run big time leverage and saying, well, maybe we didn't know about that. And then after it happens, you just fire the people that oversaw that. So it's happening. It's happening on larger scale all the time. And, I don't really care if there's a solution to it. I just want to front run it.
Yeah, no, I that's the important thing as well. It's not about, we have an intellectual and macroeconomic and obviously a market discussion, but it's not about the what we believe should be done is what is happening. That's what matters. I think that the point that you just mentioned about the Fed and central banks is that they basically started a train rolling down the track that they can't stop. At the beginning, the central banks perfectly understand that they're incentivizing taking more risk, and that they are incentivizing taking more leverage, and the concept of making savers investors, which in reality means taking a lot more risk. The problem is that once the ball starts rolling, as we saw with the repo market crisis, is that they cannot stop it, even with communication. They cannot just say, oh, and by the way, be ready because we will raise rates, as what happened with Powell. We will raise rates. We're going to do this and we're going to do that. Doesn't matter, because the market behaves in a different way. So the problem is that what at the beginning is, from the central bank perspective, a situation that is a sort of secondary effect that is less relevant than increasing growth and improving employment, then becomes the main pillar of their policy. Is that because markets react so aggressively, they need to keep the policy, even when it is not required from a macroeconomic perspective. So that's very dangerous, because that creates the perverse incentive that you just mentioned. No.
Yeah, that's an amazing thing too when you think about it. Like when the most recent bout of the Fed bailing out the market during COVID largely had to do with bailing out the leverage problem.
Yeah.
I mean, if high yield and junk bonds don't trade because they're fake junk bonds and high yields, and you don't want those prices to clear, it's far more reaching than just in markets. It's in terms of the capital structures that these companies are compensated, the executives are, to believe that they're allowed to run. And that's really squirrely, because if you use airlines for an example, I mean, ultimately it's the people that had to bail them out, both the funds that own the debt and the executives that are paying themselves out of the kitty. So it's an interesting moral conundrum. I'm not here to solve for people's morals. I have my own, and they're hard enough to stay steady with. Again, Irish Catholic, please don't cancel. It's tough. It's tough. But we're in the situation we're in. I don't know what gets us out of that. Again, like I said, I'd prefer to front run it.
And when you look at the opportunities to front run, one of the things that many of our viewers voice as a big concern is that they do see the opportunities, and they even capture some returns, but the corrections are so abrupt, so quick, and so correlated that they basically are unable to at least retain some of those gains. Second, get some money to jump back in. So it generates a situation in which, on the one side, there's anxiety because you don't generate the type of returns that the index is creating, and on the other, once there's a big correction, there is not enough capital to jump back in, or there's too much fear. So how would you suggest an investor with a long-term view should actually try to navigate such a situation?
Well, the best way to front run people with liquidity problems is to have liquidity when they're having problems.
Yeah.
And that's the main thing. And what you just expressed, it's interesting. And your audience on your YouTube channel that you're building is probably very similar to mine, in that the audience is a nice mix of people that run institutional hedge fund money, family offices, their own family office, high net worth people, et cetera, and people that are also just getting into this. So it's everyone under the same tent. I think like that concern that the individual might have who's used to running with like on margin or with leverage needs to think about it much like a hedge fund has to rethink how they're running it. Like if you're, first of all, the odds of starting a small hedge fund and rising up, like when you and I started in this business, are much lower because the motherships have taken over. So you jump into one of the pod shops and you launch. You don't have liquidity when you need it. You get tapped on the shoulder. You have to reduce your gross exposure. You have to degross. So again, it's pretty simple. Everyone's liquidity parameters get tightened at the time that you want to be buying. Like as me, the individual. So I run my own, I don't know, if you want to call it my PA, my family office, that's fine. It sounds fancier. But the fact of the matter is that, the way I deal with it, and I deal with it tactically and specifically using math. When markets get to the top end of their range, a good example is what just happened in commodities and energy stocks. We just crushed it with that because we bought a shitload of it throughout the month of March when it was consolidating. Wall Street talking points was that it was breaking down on their moving averages. So if you bought a bunch of those asset allocations, whether they be the commodities themselves, shorting the currency, the dollar being, they're huge trades. Again, what you should have been doing was selling into the rally so that on days like today, when they're finally seeing a correction in what I call my four horsemen, financials, energy, basic materials, and industrial stocks, you can mop up their liquidity problem. If you're selling at the top end of the range and buying at the low end of the range, you don't have to deal with the same kind of volatility that people that are chasing the top end of the range and quite literally degrossing or puking at the low end of the range. It's kind of like watching a bunch of, it's amazing to watch, as you know, because sophisticated hedge fund people in particular should not be chasing high and freaking out low. Yeah. They're not really doing that. They're getting tapped on the shoulder low, and then they're trying to catch up on performance high, which is an entirely different exercise, as you know, which is called cover your ass or trying to protect your job.
Yeah. that is a very important lesson that many people don't understand. Many people that we speak with think, well, they hear this concept that there's too much liquidity on the sides waiting
Yeah.
to buy. Huh? How many times
Yeah.
have you heard this? You know,
Liquidity on the sidelines.
investors are piling on cash, waiting to buy in a correction. Well, that's not true. And the other thing that is not true is that they don't understand what you just mentioned. And I think that this is a very important lesson for all those that are watching, particularly because the stocks that they tend to look at are the ones in which hedge funds tend to have those positions. Is that when a hedge fund manager gets tapped on the shoulder by the risk manager and says, hey, you know, you need to cut growth exposure, it's precisely the moment that you should be having some liquidity to look for opportunities. And that is the opposite of the way in which momentum trading, at least, is built, is that you should not be chasing that momentum. You should actually be thinking of that, of front running, as you say, that process, no?
Yeah, no, I mean, it's you have to have both parts, right? Like I said, you have to have the quad right, and you have to have the signal right. So the quad, I'm front running a big economic trend. Sine curves, economic sine curves don't change very often. Getting those pivot points is very important. So you can have, in this case, the being long inflation as an asset allocation, whether it be commodities or their linked equities, financials, basic materials, energy stocks specifically. You know, these things have been going up since June. Okay, so that's not that hard to get that right if you get the cycle turn right. What's hard is understanding when the signal's saying it's overbought and when it's oversold.
Yeah.
So that's why I do the two things. Now, specifically, having lived through it, like Jim Gatherall wrote The Volatility Surface in 2006. I was at Magnetar in 2006. That was my first time, you know, where I was basically given my own liquidity parameters, my own potential tapping on the shoulder risk factor. I was factor exposured out the wazoo, you know, and I was like, wow, I need to solve for this before they tell me what I have to do next.
Yeah.
So when you know my process, I call it trades, trends, and tails. Trades are specifically, Daniel, 3 weeks or less in duration, and that's the only information I give people on that signal. I don't give them, well, I tell them how it's constructed. It's a price, volume, volatility signal. It runs off the relationship of those three factors and how they collide with each other, the volatility of volatility specifically. But why did I use 3 weeks or less? Well, because at that point in my career, as soon as 1 month price momentum would change, I would get tapped. And I didn't want to get tapped. I wanted to front run the tap.
Yeah, absolutely.
That's like, there's a reason for everything that I do. I know for some people, they might just think that I'm just somebody who tweets, but I mean, at the end of the day, it's fine. I prefer that people don't totally understand every little bit of that price volume volatility signal, but it's really built to front run the business that you and I grew up in.
Absolutely. And let's just talk a little bit about the trends right now and the comments that we hear on a constant basis about those macroeconomic and growth trends. I would like to get your view first. Inflation, transitory or not transitory?
Not transitory for a couple quarters. I mean, it's going to hit its cycle peak this quarter is where we have it. We have inflation going to 4.21% headline. I'm assuming you're talking the U.S., but we could talk.
Yeah, U.S. is, yeah.
Both Europe and the U.S. I mean, China too. I mean, they continue to have economic stagflation, what we call quad 3. China looks bad. Europe looks a lot like the U.S. in terms of inflation readings. We have that peaking here in the second quarter. Really, it could peak into July, so into the third quarter. Then it will decelerate. So the peak will be transitory, like all peaks are. All peaks and bottoms are transitory. But we have it slowing to the high 3s or mid 3% inflation. So it'll stick. And I think that once everyone starts to give up on that it's transitory, then it'll be transitory. I have it collapsing, inflation collapsing again by the second quarter of next year. And I mean, the rate of change could get cut in half from its cycle peak. But again, getting to that part of risk managing and asset allocating everything that I do, Daniel, is like 2 careers from now.
Yeah, absolutely. Absolutely. I think that that is critical, is how important it is knowing first that cycles, economic cycles, are shorter and more abrupt. People tend to believe in the so-called 10-year cycles that I don't know where they read them, by the way, because I never saw. But the other day, someone was telling me, no, economic cycles last for 10 years. Why do you mean 10 years? Why? Because
No.
it's, I don't know. Where did you get that it has to be precisely 10 years? And so economic cycles shorter and more abrupt, and the rate of change as a critical factor. Because the key point, coming back to the asset allocation, is what you just said, is that if headline CPI rolls over, but a lot of the prices that have been elevated throughout this last months will remain significantly higher year on year, but with a rate of change that is different. And that one thing, and this is important for one reason that we're going to talk, I'm going to ask you your opinion about right now, is in 2018, 2019, we saw protests all over the world against the rise in the cost of living in Chile, in Spain, in Germany, in France, every week, etc., etc. What we it seems that there is something that is very difficult, at least for investors to understand, is that you may have an inflationary spike in which consumption and margins don't translate into higher levels compared to the previous process. How do you see that situation?
Yeah, that's in my model. That's called quad 3 stagflation. So absolutely, yeah, that is going to be a rising probability, particularly in the U.S. as the currency continues to be devaluated. So again, in the U.S., there's only one economic quad where the currency is going to go up, quad 4. I do think we're going to have a brief quad 4 market event in the sometime this summer. And then the Fed's going to come in with more cowbell. You weaponize it with Janet and you have MMT. They're going to try to control print jobs till you get to quote unquote full employment. You know, you do that and the dollar keeps going down. What's going to happen is that you're going to have economic stagflation, which is exactly what you said, which is the costs in people's P&L if they're running companies. And again, the amazing thing about the government is that they've never run a company. But I mean, obviously, you know, your labor is going to stick for sure with Janet Yellen, the labor economist at the helm, and C.C. Rouse from Harvard, who's the head of the CEA at the helm. You know, so labor is going to stick. Owner's equivalent rent's going to stick. At some level, you're going to have a sticky set of food prices, and you know that's in people's input costs. So if you don't have pricing power, your margins get squeezed. Then you fire people again, and then Janet's going to say, "Well, you got to hire them again." It's going to be really interesting to watch because this is the first time where we've weaponized, you know, politicized officially as opposed to pretending it wasn't political. The Federal Reserve of America, which is putting Janet Yellen, the former head of the Fed, who is allegedly apolitical, who is about as politicized gets right now, trying to offset the cycle on the labor side when margins start to get, you know, crushed again.
When margins start to get crushed and employment starts to fall, you've mentioned twice, and we've been talking about this for a while, the risk of stagflation. However, we have at least 3 generations of traders that have never seen stagflation. So
we have a whole generation of traders that we just realized haven't even seen inflation.
Have never seen, and have never seen a real tightening of monetary policy. They don't know what tightening is. They call normalization going from 120 billion purchases to 110. That's not normalization. Like going from eating 12 donuts to eating 11.
That's great.
But let's talk a little bit about that in your opinion. Stagflation. Because I think that I would say that most investors find themselves more or less able to navigate inflation and deflation. But stagflation, wow, that's a difficult one.
Well, let's just start with who it confused royally, which is Warren Buffett in the 1970s.
Yeah.
And I actually wrote my senior thesis at Yale on this, which is really he was confused and confounded by the multiple compression on these. He's a valuation guy, right? He's buying these equities, and cheap equities continue to get cheaper. He's like, this doesn't make any sense. But it does make economic sense, actually, when you think about it. This is, of course, when the S&P 500 in the 1970s went to 7 times earnings.
Yeah.
Right. The economic quadrant, or the economic scenario, which is the quadrant, stagflation, if it is pervasive and it runs like for more than a couple quarters, it becomes a huge multiple compressor for equities and for high yield debt. And that's literally, the lesson of the 1970s. So I do think, like, while central banks and all these politicians with their MMT ideas, it's rainbows and puppy dogs, but the companies are going to have to deal with the margin compression and that stagflation in their P&L. And I think that that's probably the biggest risk, is that you have a committed government in the U.S. ahead of a midterm election where they're trying to buy the votes, where they're trying to buy student loan debt. They're trying to give you first-time home buyers. These millennials, they want their votes. There are 95 million Americans that are millennials still. There are 4.875 million 30-year-olds in America. So those are the votes. They want the votes. They want to give them all the goodies, but all the goodies give you stagflation. Because they keep the housing, which is, shelter, is a third of the CPI. Not that the CPI is real world inflation, but it's a good proxy for the direction of inflation. And, that thing's going to not only go up a lot, but it's going to stay up a lot if you subsidize all these things. So I do think that that's really, and back to the Buffett point, like the punchline on it was like, oh, well, screw it. I'll just buy the whole company then.
Yeah.
If they're going to give it to me at 3-4 times EBITDA, then in 4 years, I know what I got. And, that was a very unique point in economic history where politically that was perpetuated and it ran out of rope. Paul Volcker took out the rope.
Absolutely. Very important factor here. Stagflation, multiple compression, friends, because many of the people in the market discourse think, oh, stagflation, high inflation, then multiples expand. No, they don't.
No.
More importantly, very few of those generations of traders that have not seen normalized monetary policy did not see price controls. After, first, you say inflation does not happen. Second, you say it's transitory. And third, you blame businesses for the increase in prices. So government presents itself as the solution and implements price controls. And that destroys the multiples of the companies that tend to be viewed as precisely the ones that could benefit from the inflationary pressures, because they're also very large. And in some cases, not in the United States, but certainly in Europe and in emerging markets, semi-state owned. So very careful with those sectors. The point that I wanted to touch with you as well is the market right now sees that, and we see, for example, in the way in which the 10-year bond is behaving, is, well, yes, inflation is coming up, but the 10-year bond is not going above 2%. No? So the market seems to discount that the Fed will keep yields of sovereign bonds low, whilst inflation runs above their target. No, what is your view there, and what do you think is the biggest risk as an investor of playing that theme?
Well, it's been, again, mathematical in my orientation. I don't ask a valuation god of some other earth for the answer to that question. My math is still saying that the 10-year yield is going to go to somewhere between 1.9 and 2%. And then the real debate will start. So again, that's another 30 basis points higher from here. My model's still saying that German Bund yields are going to go positive as opposed to being negative. So there's a lot of runway. Actually, the German 10-year yield could easily go to 50 basis points. Imagine that. But again, just up is where we're going to go to the point where time and space runs out on the clock. Quad 2 gets bond yields to go up. Quad 3, well, first of all, Quad 4 makes bond yields to collapse. Quad 3, if that's where the central banks want to push the economy, without admitting that that's what they did, that's where bond yields are flat with a downward bias. Yes. So that's been my setup since really since November. I'm still in it to win it. I still think, today European bond yields hit a new cycle high. I think the German 10-year at one point was -8 basis points. It's funny to talk about it that way, but really the Italian 10-year yield's a good example. It's up to almost 1.25%. It's up 35 basis points in the last month alone. And again, if the Italians can even show an economic acceleration on growth and inflation, pretty much anyone can. So no offense to the Italians. I love Brunello. I love Italy. I love you all. But I just think that we have this hot window that the Fed is really not the catalyst for bond yields. The data is.
Yeah, very important factor. German bond goes to those levels. The flow of capital does not go into the Southern European indices. No way.
Right.
And I think that is something that people need to understand, is that capital flows don't work the same in the United States as in Europe and emerging economies. No, and in emerging economies, you have the added risk factor of the currency. But in Europe, if the bond goes to those levels, you don't see multiple expansion on the allegedly, well, on what is right now, I believe, and I don't know if you agree with that, from the sell side, the consensus call is long European equities, no?
Yep. Oh, I've been long European equities for a while, so it's not like a new call. Now, of course, all the charts look good, so the chart monkeys are chasing them. And to your point, the European investment banks that are in the business of doing investment banking with the companies still like the companies. That hasn't changed. Last I checked, I don't remember any European bank not liking their European equities.
Absolutely not. Absolutely not. One of the other constant messages, especially after what the ECB did at the beginning of the year, in which that made it react very aggressively for a very small increase in yields and the spreads in the Eurozone, is the belief that any central bank action can contain bond yields from rising. However, we're seeing that it's not the case. No, that it can suppress them for a while, but it does not stop the trend. How do you explain that to people that think that central banks have the magic wand on everything?
Well, unless we're talking about Japan, who has yield curve control and no yield curve as a result. I mean, the short end of the curve is where the Fed keeps the interest rate, and the long end of the curve is where inflation's headed. And it's very simple. And so until they can tell, and that's why bond yields, I mean, I think I have a conservative estimate on 1.93 or 1.94 or 1.95 on the 10-year yield, is that if this thing, if commodities continue higher, dollar continues lower, there's scope for, just on mean reversion alone, for the 10-year yield to go towards 2.75, 3%. And if that happens quickly, then there's going to be bedlam on Wall Street. I mean, they've already lost their mind every time bond yields go up 20 basis points in a week on the 10-year yield. And that's systematically has flushed out a lot of people, but not if you've expected inflation to surprise people to the upside. That's when you should expect bond yields to surprise people to the upside. I heard one of the old wall economists after the most recent moves, like, well, that's a nonlinear move. That just doesn't happen. And I'm like, dude, nonlinear moves in bond yields happen all the time. Like, I don't know, it would only take somebody who's not run money on the buy side to say something like that. That's exactly the point, is that when inflation surprised to the upside, bond yield surprised to the upside. And it happened in that order, not the other way around.
That is critical. That is precisely the point, is that in an interview the other day, they were basically telling me that the inflationary spike should not be believed because bond yields are not reflecting it. Bond yields reflect it afterwards. They always do, don't they? Yeah. I mean, it's almost I mean, it's not even a debate. It's something that you can actually show that happens. No,
it's an empirical fact. I mean, if you look at like commodities is the best example most recently. Commodities consolidated, broadly, the CRB index, 19 commodities, consolidated throughout the month of March. Yeah. Throughout April, U.S. 10-year yields corrected, and people are like, oh, this is perfect. This is Goldilocks. Then all of a sudden, the April CPI number comes out, which is a function of the commodities that went up. And in a day, the 10-year yield goes from, actually, it was from the employment report to the high of that day, was a 20 basis point move in the 10-year yield to the upside. So you got, like, pros know how to risk manage this. You know how, I know how. What I love about the setup, it's kind of a perverse thing to say because I'm preying on that's it with a PREY. I'm also praying. I mean, I'm praying that they stay around, because you have these macro tourists back to the beginning of the whole thing that have no idea about the macro cycle. They're just like chasing inflation headlines and things of that nature, which help you make more money.
Yeah, Very interesting. And one of the interesting points that you've just mentioned is that the inflationary cycle that we have seen in commodities has been so correlated that we hear the rhetoric out there that it's all just because of supply chain disruptions. However, you have commodities that are up 30% on the year that have oversupply. So it's amazing to see. I posted it actually the other day, or I think this morning, I don't remember, the level of overcapacity that exists in the system right now. With the United States capacity utilization is about 74%, and you don't have any of the G20 economies actually at a level of capacity that would be considered pre-pandemic levels. No, so it's interesting there to understand that the inflationary pressure is directly correlated with the money supply growth of the past year, in which for the first time in a very long while the United States increased money supply way above demand. No, and that comes to the point that you mentioned before briefly, which is this MMT mirage that we see, or flying like a vulture all over us everywhere.
That's what it is.
Do you think that do you think that the Biden administration is going to push that limit?
Oh yeah, I mean that's like Janet didn't just get a text one night, and said, maybe I'll think about exercising my inner full employment self. I mean, this is completely orchestrated. I mean, as you know, she wasn't exactly like the front runner all along to head the Treasury, and she's the perfect one to marry it up between. Powell's going to be gone next year, and I think they'll probably put in Lyle Brainerd, and she worked with Janet. So yeah. I'm expecting. I guess I always say to kids that I coach and players on our team at the firm that I coach analytically, embrace the uncertainty, because you have no idea what these people are going to really do now that they have their hands on both sides of it. They can print it and they can spend it. They got the machine going and they could go as far as you could imagine. I mean, if you were to go as far as you can imagine politically, you go to the progressive left side, AOC, I mean, she wants 10 trillion in infrastructure spending.
Yeah. 10 trillion in infrastructure. It's a very interesting figure, because Japan spent 9 trillion in infrastructure to deliver 3 decades of stagnation, my friends in America. Enjoy becoming the European Union.
And Bernanke's always said, who's the man behind the mask is, he's there. It's like watching some kind of Star Wars, version. Like once you get to the backstories, you can see that the guy has always thought that if America just did more in the moments that it mattered most, then there would have never been problems like 2011. There would have never, so they really, I don't doubt at all that they'll try doing more than Japan. The definition of insanity is doing more and more of the same and expecting different results.
Absolutely, it is. Absolutely, it is. And when you have people out there saying that it's a great success to have a so-called very tight labor market because people don't want to work because they get a check from the government, then it scares me. It scares me very, very much. The lack of understanding of what a tight labor market is.
That's human behavior, right? You and I have lived in both America and in our own homeland. Both of our homelands, historically have leaned more left. So, in Canada, you get this thing called Pogie. So a lot of I got a lot of buddies at home. Like if you're going to get paid, to go swing a hammer, or you get paid something that's pretty close to that, and your fishing license and hunting license are up, why don't you go on Pogie and go fishing and hunting with the money that the government pays you to do it instead of swinging a hammer? It's not that complicated to understand human behavior.
Yeah, absolutely. No, it's not just not complicated. It is scary to see that people want to believe the most dangerous words in economics, which are "this time is different," huh? And it isn't. Keith, we've had a great discussion. I encourage everyone to follow you and to continue the dialogue. Keith is on top of markets every moment. You know, it doesn't matter which continent you're in, because by the time you wake up, he's already he's already there. Yeah, I don't know how you do it, but Keith, we've had a great time. Thank you so much. It's always a pleasure talking to you. And I come back to the point. All of you should really read this book, Diary of a Hedge Fund Manager, and follow Keith and Hedgeye. Thank you so much for everything. It's been a great chat.
Awesome doing it. Thanks, Daniel. Always a good time.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.